Hi, my name is Paddy Hirsch. I'm a senior editor at Marketplace. Today I want to talk about government debt. A lot of people have been asking questions about how government debt is issued, because the government's been obviously borrowing a lot of money from the marketplace using Treasury bills, Treasury bonds, Treasury notes. People are kind of confused about the differences between these things, so I'll see if we can spell it out real quick. So here we go. We've got bonds, we've got notes, and we've got bills. Okay, and these are all types of security that are issued by good old Uncle Sam. Here he is. This beard. He has a big smile on his face. And Uncle Sam is going out and he needs money. Okay, say he needs $30 billion. Okay, so he's going to use all three of these types of securities to get it. So what does he do? He issues $10 billion in 30-year bonds that are priced at, say, let's say 2%. Okay, $10 billion in 7-year notes that are priced at, say, 3.5%, and $10 billion in 6-month bills. Okay, so you can already see the chief difference here in between bonds, notes, and bills, and they are to do with tenor. Okay, the maturity of the paper that's being issued, of the security. Rule of thumb is if it's more than 10 years. Okay, 10 years plus, you know it's going to be a bond. If it's 30 years, 20 years, it's going to be it's going to be called a bond. If it's between 1 and 10 years, okay, that piece of debt is going to be called a note. And if it's less than 1 year, it's going to be called a bill. Okay, so that's really the essential difference between these three. Is the tenor. Of course, there is one other difference that we can see here, which is the interest rate. Okay, in the case of the bonds and the notes, you have a fixed interest rate, just like a regular bond. In the case of bills, you don't have that. Now, whenever the government actually goes out and it raises this money, what it does, we hear about it selling securities or selling treasury bonds. What it's essentially doing is it's borrowing money from the market. And the way it does that is it goes to a network of banks that it has, and it says, guys, I need you to help me raise this money. Can you go out and can you sell these bonds, notes, and bills to investors of various kinds, whether they be governments or institutions or individuals? Get me that money, and I'll be paying them the interest rate, and I'll obviously pay you a little bit of fee on the way. Okay, with the bills, it works slightly differently. Say I want to buy $100 million of this issue of bills. What I do is I go to one of these banks, and he gives me this piece of paper. It says for $100 million, it's a bill to be paid back in 6 months' time. Okay, it's $100 million. But instead of selling it to me at its face value of $100 million, what it does is it sells it to me at a discount. And depending on how big the discount is, that's how much money I make. So say it sells at a discount of 98 cents on the dollar, or 98%. So at 98%, I pay $98 million. Okay, that's my money that I pay to Uncle Sam. Okay, 6 months later, I return this bill to Uncle Sam, and in return, Uncle Sam gives me $100 million. So I've made a very tasty $2 million on the side there. So that's my net, is $2 million. That's how much money I make. And that's kind of where the interest rate comes in. That's the upside of investing in these bills. Okay, so who's buying these bonds, notes, and bills? Well, as I said, it's all sorts of people. Everybody from the Japanese government right down to, well, me. I mean, I can buy treasury bonds if I want to. And why would I want to? Well, there are a number of reasons. The first reason is because I think it's safe. Okay, say I'm an investor and I look at the market, and I'm looking at the market now and I think things are a little bit dodgy. I think to myself, I don't want to invest in the market right now. It seems too dangerous. But rather than sitting on the cash, which isn't going to earn me any money at all, or putting it in a bank, which is going to earn me a fraction of money, maybe I should invest in one of these securities. Then I maybe get 2% a year, so there's a little bit of money, a little bit of a hedge against inflation there. But it means that it means my money is essentially safe, or I believe that my money is safe. The second reason is it's very, very liquid. So if I'm a big pension fund and I say I've invested $100 million, or I've got $100 million to invest, I want to put it somewhere that it's going to be earning money, but I can get it back really, really quickly. I could do that with a money market account. I could do that with a bank, but I could also do it with a treasury bond, because the treasury securities are extremely liquid. There's a big market in them all the time because everybody's buying them, because everybody believes that the US government is secure, and a lot of people are interested in holding this stuff. So it's really easy to trade in and out of. So if I've got my note for $100 million, I can sell it into the market and get my $100 million back really, really quickly. So that's the advantage of doing that. But of course, a couple of words that I've been using, a lot of language I've been using, illustrates the difficulty here, because it's kind of it illustrates the hedging that I've been doing, because I've been saying almost, pretty much, almost certainly. We're almost certain that the US economy is going to be safe over a 30-year period. We're almost certain that the market in these securities is so liquid, I'm going to be able to get my money back really, really quickly. Is that almost is the thing that worries some people, and those are the kind of people that invest in solid commodities like gold, because they worry that the entire economy could collapse and they'd be left holding nothing but bits of worthless paper. Okay, so that almost is the thing, because obviously if you're holding $100 million in 30-year government debt, and then the US economy, God forbid, does collapse in 20 years, well, it's going to leave you holding a valueless piece of paper and, frankly, very badly, needing a drink.